I think investors certainly want to stay defensive, but the new question has become, what is defensive? Right? First half of this year, the most defensive strategy was high-yield SOEs, right? That's one pillar of our tripod strategy. And indeed, whether it's the financials or coal, energy, telcos, significantly outperformed in first half of the year. But after the outperformance, their dividend yield has come down. Some sectors are facing, like energy, coal, are facing earnings pressure, and positions are getting a bit crowded. So even the defensive sectors might not be so defensive. That's why we're seeing some of the correction in the SOE sectors. So by now, I think, like you mentioned earlier, investors now favor financials, banks, because at least from earning perspective, China major banks' earnings are probably more predictable or have less downside.
But then what about the concern around the pressure on NIMs, particularly off the back of the PBOC's cut to rates earlier this week, and also given sort of the double whammy, the double-edged sword for some of these banks, which are really feeling the pressure from the authorities to increase their exposure to the sort of cash-strapped developers?
Absolutely. Fundamentally, I think banks' fundamental in terms of their margin, fee income, core earning power has been deteriorating significantly over the past 2-3 years. But on the other side, I guess, buying banks, it's pretty much a very defensive, ultra defensive move because banks are very late cycle. So by now, in terms of the margin, potentially banks have some levers to pull in terms of further lowering the deposit rate. So bank second quarter margin will probably be stable-ish because they were able to adjust some of the previous negotiated high-rate deposit. And going forward, given China's low inflation environment, there might be room to cut the deposit rate. But I agree that, if economy doesn't recover, banks as proxy to the fundamental economy, their earning power getting deteriorated and their asset quality pressure will be mounting up. So parking money in the banks might not necessarily be a sustainable strategy if the economic fundamental doesn't turn around.
Zero. Is there room for further weakness for the Chinese yuan or not quite? Would China use the yuan as leverage as it did in the past in the Trump 1.0 tenure when China let the currency weaken against tariffs?
Yeah, that's certainly a popular trade among the U.S. investors in comparison to Trump 1, right? 2018, 25% tariff, RMB depreciated by nearly 10%. So market do have some expectation of potential currency weakness. But I guess from China's perspective, there are other considerations about the currency, right? China's been trying to push for RMB's internationalization, RMB's role as a reserve currency, as a global settlement trade payment currency. If that's the long-term, agenda, they probably want to maintain the currency stability rather than sacrifice currency for 10-20% depreciation just to boost the GDP by 40-50 basis points. So there is a trade-off, and we certainly need to see what's the choices to be made. But I think from China's perspective, usually they would prefer to defend the currency stability. But, let's find out first half next year, they will probably evaluate other part of the economy, right? How is domestic consumption doing? How is the property market doing? And what's the impact on the export market?